Hey everyone, and welcome. Today we are diving deep into a really big idea. The thought that the basic fundamental rules of financial markets have totally changed. You know, for decades, we all played by one set of rules. But now? Well, now we're in a whole new ballgame. What some are calling the volatility decade. And in this new era, the old playbook isn't just a little outdated, it's actually dangerous. So let's get into it.
The source material for this explainer kicks off with this really powerful, kind of cryptic line. It suggests there's a danger out there, one we can't see, and that the old warning signs we used to count on are just gone. So what on earth happened to the canary? And more importantly, what does that mean for how we invest our money?
To really get our heads around this new reality, we need to rewind the clock to a crazy 4-day stretch when the entire system almost came crashing down. It all went down in the UK in late 2022, and the speed of it was just breathtaking. This wasn't just, a bad Tuesday on the stock market. This was a legitimate near-death experience for one of the biggest economies in the world.
Okay, just look at how fast this happened. Day 1, a brand new government announces a pretty standard, if ambitious, economic plan. By day 4, just 4 days later, the central bank has to hit the panic button and stage a massive intervention to stop a £500 billion fire sale that was threatening to wipe out the entire British pension system. In the middle of all that, the interest rates the UK government pays on its debt just exploded higher at a speed nobody had ever seen. The sheer violence of the market's reaction, that was the real story here.
And this right here, this is the main point. The mini-budget itself wasn't really the cause of the crisis. It was just the tiny little pebble that shattered an already cracked sheet of glass. The real problem was the environment. Those invisible structures, the so-called containment frames that used to absorb shocks and keep things stable, had become weak and incredibly fragile over the years.
So, this new brittle market environment has absolutely massive implications for how we all invest. Specifically, it means that the one strategy that millions, maybe billions of people relied on for safety, the absolute bedrock of prudent investing, it didn't just bend, it failed, spectacularly, right when we need it the most.
Which brings us to the multi-trillion-dollar question. For literally decades, the 60-40 portfolio, that's 60% in stocks, 40% in bonds, was the undisputed gold standard. It was supposed to be safe, reliable, the perfect recipe for long-term growth. So why, in 2022, did it just completely fall apart?
This table, honestly, it tells you everything you need to know. Look at 2008, the big financial crisis. Stocks got hammered, right? But bonds went up. They moved in opposite directions, what we call a negative correlation. It worked exactly like it was supposed to, cushioning the blow for investors. But 2022, a completely different story. Inflation was spiking, and this time both stocks and bonds went down, together. The shield that was supposed to protect you didn't just fail, it actually broke and became part of the weapon hurting you. And the result was this, a devastating 17.5% loss on what was supposed to be a safe, balanced portfolio. I mean, this wasn't just a bad year, this was a total structural failure. It was a giant, flashing red light telling us that the fundamental logic of safe investing had been turned on its head.
For 30 years, this relationship was as predictable as gravity. During an era that economists actually called the Great Moderation, everyone just assumed that if stocks had a bad day, bonds would be there to save your portfolio. That was the whole secret sauce of diversification. But in 2022, we learned a terrifying lesson. Gravity itself can be switched off.
So all of this brings us to the absolute core of this explainer. We need a radical new way to think about markets. I mean, if the old physics are broken, we need some new ones, right? And that starts with fundamentally changing our entire relationship with the concept of volatility.
Right. So the old way of thinking, the old physics, saw volatility as just noise, a bug in the system, a problem that you had to avoid at all costs. You built your whole portfolio to protect yourself from it. But the new physics sees volatility as energy. It's a fundamental feature of the market, something that you can actually understand and even capture. It's a huge shift from a defensive crouch to an offensive, forward-leaning stance.
So how do you actually harness this energy? Well, the key is something called the Volatility Risk Premium, or VRP. Let's make that simple. Think of it as the gap between how much investors fear the market is going to swing around and how much it actually does. Because we as humans are naturally risk-averse. We hate uncertainty. Investors consistently overpay for insurance against big market moves. The VRP is basically the profit you can earn by being the one who sells them that insurance.
And the historical numbers on this are they're stunning.
This chart shows something called the Sharpe ratio, which is just a fancy way of measuring how much return you get for the amount of risk you take on. Your typical passive stock portfolio gives you a ratio of about 0.4. But a strategy that's actually designed to harvest this volatility premium, historically, it's delivered a ratio of 1.0. That is more than double the bang for your buck risk-wise. It's a huge difference.
Okay, so this isn't just some abstract theory. There's an actual new playbook for putting this stuff into practice. But it does require a fundamental shift in the kinds of questions we ask as investors.
The old playbook was all about direction, right? Is the market going to go up or is it going to go down? The thing is, that's incredibly hard to predict consistently. It means you have to guess about central bank moves, corporate earnings, geopolitics. It's almost impossible. The new playbook focuses on something else, magnitude, and asks a much simpler and frankly more answerable question. Will the market move more or less than people are currently expecting? You're not betting on where it's going to land, you're just betting on the size of the journey.
And that's the key insight, right there. Harvesting volatility isn't about being a genius who can predict the future. It's about being able to profit as long as the market moves less than people were afraid it would. You are literally being paid to provide stability and absorb the risk that everyone else is frantically trying to get rid of.
So what does all this mean for you, for us? How do you actually build a portfolio that can not only survive, but actually thrive in this wild new era? Well, it all comes down to a few core principles.
So a robust portfolio for this new decade needs a totally different DNA. You can think of this as a checklist for your own strategy. Is it independent of that now broken stock-bond relationship? Is it actually built to be aware of volatility? Does it focus on magnitude, not trying to predict direction? Is it built to survive a massive shock? And finally, is it systematic, so it uses rules to keep our own emotional decision-making out of the picture? The traditional 60-40 portfolio, it fails on pretty much every single one of these points.
And so, that's the question we're left with. The new physics of the market are here to stay. That energy of volatility is going to be released one way or another. So the only choice you really have is this. Is your portfolio positioned to be captured and broken by that energy? Or is it designed to capture and harness it? Thanks for tuning in.